It is Friday, March 20, 2026, and we are now seeing the true scale of the March 19th massacre. QatarEnergy CEO Saad Al-Kaabi has just issued a sobering update. The damage to the Laffan complex is estimated at $26 billion in infrastructure costs alone. More critically, the 17% hit to Qatar's LNG export capacity, roughly 13 million tons per year, will result in a staggering $20 billion annual revenue loss. This isn't a short-term outage. Experts now believe it will take 3 to 5 years to fully repair the damaged LNG trains. The Pearl GTL facility, a crown jewel of the Shell-Qatar partnership, is also partially offline and expected to stay that way for at least a year. The military situation has reached a boiling point. The Pentagon has officially launched an offensive to reopen the Strait of Hormuz, deploying low-flying gunships and helicopter patrols to secure the waterway. However, the IRGC has retaliated, claiming to have struck a U.S. F-35 over Iranian airspace. Defense Secretary Pete Hegseth is now requesting an emergency $200 billion for the war on Iran, while Tehran warns of zero restraint if energy sites are targeted again. Global trade is bracing for a massive contraction, as the WTO warns that prolonged instability could slash global merchandise trade growth to just 1.4% this year. The global financial markets are in a state of high-alert volatility. Brent Crude has shattered the $115 barrier in early trading today, as investors price in the possibility of $150 or even $200 oil if the strait remains contested. The ripples are being felt most acutely in Asia. Japan's Nikkei plummeted 3.4% today, while the Kospi and Hang Seng saw similar bloodbaths as they calculate the cost of a future without stable Qatari gas. In the U.S., the triple witching event today, the simultaneous expiration of stock options and futures, is adding fuel to the fire. While the S&P 500 has shown some resilience due to a flight to defense stocks, the broader market is buckling under the weight of an ECB inflation forecast that has jumped to 6.3%. The crypto market is telling a tale of two cities. While Bitcoin initially surged as a crisis hedge, it has pulled back below $70,000 today as liquidations hit leveraged traders. Interestingly, XRP has seen a massive fundamental win with an SEC digital commodity classification, yet its price remains suppressed by the macro environment. We are seeing a new correlation emerge: energy-gated crypto. As global power prices rise, the cost of securing the network is becoming a primary market driver. Investors are no longer just looking for a store of value, they are looking for proof of power in an energy-scarce world. Finally, we look at how this energy war is colliding with the AI revolution. S&P Global released a landmark report today declaring that the era of linear energy transition is officially over. The massive energy demands of AI are now competing directly with national security for a dwindling pool of reliable power. We're seeing the first major casualties in the tech sector. Supermicro shares plummeted 20% after the U.S. charged its co-founder with smuggling AI chips to China. This highlights a growing Cold War 2.0, where compute power is treated with the same level of export control as nuclear material. Meanwhile, tech giants like Tencent and Alibaba are seeing their valuations slashed as the market realizes that AI investment now means buying power plants, which eats into the buybacks and dividends investors once craved. The message for March 20, 2026 is clear. Intelligence is no longer the scarcest resource, energy is. Whether you are managing a stock portfolio or a crypto wallet, you must account for the energy premium. The winners will be those who control their own electrons. I've updated the data room in the description with the new Qatar damage reports and the Pentagon's latest war funding request. Subscribe and stay tuned as we track this unprecedented shift in the global order. I'm Chris, and this was your Friday Global Briefing. Stay resilient, stay sharp.